Welcome to the Trestlebridge Capital Market Observations Call for Tuesday, September the 5th. I'm your host, Eric Jefferson. Trust everyone had an enjoyable Labor Day weekend. As well, for anybody that put up an out of office in late May, welcome back. Today is your friendly reminder to go ahead and turn that off. A few things to discuss today, but before we get started, a quick word from our legal team. With that, we can go ahead, dive right in. I'd like to begin by recapping where we are now 8 months into the new year. I've seen the S&P trade nearly 18% higher from January 1 levels. As we've talked about, that has been led by a select few of mega cap technology companies. A very interesting trend when we think of the dominance that growth stocks have had relative to value, despite the fact that interest rates have continued to march modestly higher. Typically, it's growth stocks underperforming in that environment. Certainly not been the case this year, although that impact has been felt in the bond market with virtually flat returns. As we think about stocks, we recently finished the Q2 earnings season. That's where companies share their financial results. 79% of companies within the S&P 500 exceeded those quarterly expectations or those hurdles that were set for them. That figure in line with long-term averages, but one very interesting takeaway was the lack of reward or benefit, meaning the lack of a initial pop in their stock price following that encouraging data, like has historically been the case. That's especially interesting when we consider the two drivers of stock prices. One are valuations, or what investors will pay for those earnings, the other being earnings themselves. With valuations currently towards the higher end of their long-term range, you would have thought that it's earnings growth that would propel this market higher. Interestingly enough, positive earnings surprise, not necessarily rewarded in the way that you would have maybe thought. That will be a very interesting theme to stay focused on, particularly as we get further into the month of September. That is historically one of the worst months for the stock market, and all of this against the backdrop that once again we are potentially facing a government shutdown on October 1st of next month. That certainly would be a catalyst of volatility if not resolved prior. As we quickly recap some of the major headlines, a few weeks back, heard from Fed Chairman Jerome Powell at the Jackson Hole Summit. There he, not surprisingly, reiterated his commitment to get inflation back down to those long-term averages. Wasn't all bad news, though. Certainly did acknowledge some of the progress that has been made. As well, for the first time in a while, started to address some of the softening in the labor market. Last week, got some mixed data, several different payroll reports, some above, some below expectations. The two things that jumped out, though, the job openings meaningfully lower than what we've seen over the last 2.5 years. As well, unemployment ticked up to 3.8%, still well below the long-term average of 5%, but that does represent the highest level where we've been going all the way back to January 1st of last year. As we think about the economic front, quiet week this week, exception to that being, of course, the NFL kicking off their season this Thursday night. And then in a non-financial news, very, very melancholy announcement with the passing of Jimmy Buffett. That's all for this week. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.